Hey everyone, in this video I'm going to talk about why duplexes are actually potentially not a good idea to invest. I know so many of you are lured in, enticed by duplexes, but we're going to go through in this video why you actually need to think twice, maybe 3 times before actually going ahead for what seems to be too good to be true. Okay, so hey, my name's PK. I help people achieve massive passive income in property investing, not quickly, but over time. Through investing in the combination of growth and high yielding property without spending a fortune on a buyer's agent, without spending their weekends at inspections, and without wasting time on real estate. We don't even touch those websites, RP data, or any of that stuff. We go to true data. Anyway, in this video, let's go down into the pros and cons of a duplex. Now, what is a duplex? I'm not talking about granny flats or dual living. I'm talking about where you have one big house cut up into 2 self-contained, separate tenancies, separate entrances on one lot, one block, one title. Okay, that is what I'm talking about. And so many of you, I know that you've been seeing ads for this. I know that you've been seeing ads for, hey, duplex, great cash flow, great depreciation, instant equity, $100,000, $200,000, $300,000 of instant equity guaranteed in a year's time. Let's just back the truck up and really analyze this. And if you watch this video, you're going to learn a lot about actually why they may not be a good idea, why you need to think twice, 3 times about investing in a duplex. Now, so many of you have already invested. You've already bought in places like Maitlands, even far more west out Newcastle, Farley, Thornlands, all these places where there's a million duplexes going in. So many of you have bought in places like Browns Plains, Ipswich, Logan, duplexes galore. They seem so attractive, but here are the facts. Now, don't get me wrong, there are some good things about duplexes. A, cash flow. Cash flow is not bad for duplexes. It's not a negatively geared property. So tick, it actually is pretty good cash flow. And the second biggest reason why people invest in duplexes is because instant equity. Now, unless you're going through a marketing company, unless you're buying some dodgy developer stock, if you're actually doing a bunch of the legwork yourself, there is actually a good chance that you can make $50,000, $100,000 of instant equity. Now, what we call instant equity in this context is not instant. It takes a year, 2 years, sometimes, although they won't admit it, 3 years from the time of the land being registered to your first tenant actually moving in. So instant equity, $50,000, $100,000, well, it's equity, but it's gonna take you a year, 2 years, 3 years to realize it. But that's still good. It's not bad. You can do better, but those are the 2 big pros. And look, there's other minor pros, but these are the big 2 reasons why people invest in duplexes, but there's so many downsides as well. I don't sell duplexes, I don't sell anything. So here's the facts, okay? So the downsides, number 1, normally duplexes are in areas in fringe parts of a capital city. So you might find them, between the Gold Coast and Brisbane in that kind of vast emptiness where there's nothing except duplexes. I'm talking places like Omeo, exaggerating a little bit, but places like Omeo Heights, places down below Logan, Marsden Park, Park Ridge, areas like that. In Newcastle, not proper Newcastle, but out even west of the Maitlands area, in around western Melbourne, out past Werribee, out towards Melton. Some of these are coming up. So they're generally not in good areas. So even though, yes, the cash flow is good, yes, the instant equity or equity might be realized over 2 or 3 years, this is fundamentally an asset you're going to buy and hold for a long time, and it's not in a very desirable location. Okay, so that's the first thing. You'd never buy a house and land package in these areas, what to speak of a duplex. Okay, so because they're not in desirable areas, and I don't want to just use the word desirable because it's very subjective, in areas where short-term growth right now, as I'm recording this in 2021, the data does not stack up for these areas to grow, then what you're actually saying is, okay, I'm going to sacrifice the growth, I'm going to sacrifice the long-term, short-term growth for a bit of an instant equity hit. So that's up to you whether you want to do that, but ultimately you want to buy an asset that grows in the short term and the long term. The second con, or the downside, is the land to asset ratio. So buildings depreciate, land appreciates. When you buy and build a duplex, you're paying much more than 60-70% of the value of the purchase, normally around $600,000 to $700,000, on the actual build itself. Because it's, you know, it's a big house, it's lots of rooms, the dwelling is large. You're not paying much for the land, you're paying less than 20-30% for the land. Now compare this to an exact another house in this exact same suburb, but something that's established. You're going to buy that. Even if you wanted to pay 600, you're going to pay predominantly for the land. 60-70% of land, maybe 20-30% of the purchase price will be the actual building. Now land appreciates, buildings depreciate. So you put those two things next to each other, even if they're in the same suburb, which does better over time in terms of capital growth? 10 times out of 10, it's going to be the established property. So land to asset ratio is just one of these fundamental, it's not even rocket science, it's just fundamentally true. It's fundamental property economics, and you're breaking that law when you invest in duplexes. Number 3, they're very expensive. I don't know how many of you have bought a duplex for under 600, but it's pretty hard going, right? So you're normally spending $6,000 to $7,000, maybe $750,000 on a duplex. That's a lot of money to be forking out on your first, maybe second investment property. You generally want to be spending less than that, right? And one of the reasons for this is number 4, is that banks prefer you to buy cheaper properties. Now, we're not saying $200,000 properties, but where a bank will give you $350,000 loans, they may or are quite likely to only give you one $600,000 loan, right? So 350 times 2 is 700. Compare that with one more expensive purchase, 600. So you're limiting your borrowing capacity, you're limiting the amount you can actually spend. And if you have a real sort of desire to earn passive income, then what you want to be doing is maximizing your portfolio value, not in terms of number of properties, but the value of the properties that you hold. So the way to really maximize that is to not buy cheap properties like 200K, but not buy expensive properties above $600,000, $700,000, $800,000, because if you continuously built your portfolio in properties less than $500,000, and let's say you got to a total portfolio value of $3-4 million, if the same exact person continuously bought duplexes or expensive properties, $600,000, $700,000, $800,000, that same situation, you will not be able to get to a portfolio value of that same $3 million. The bank will kind of just hold you back a little bit. And the reason is, the more you spend in terms of property purchase price, the less the banks in totality will borrow to you. Now that's a generic statement. There is some exceptions to that, but that's, it's true. So that's another downside of duplexes. You're spending a lot of money and handicapping yourself in terms of long-term borrowing capacity. What are we up to? Number 5 or something, number 6 or 5. Some people buy strata titled duplexes. So what this means is, whereas the initial lot or initial title was one with 2 separate tenancies, they've strata titled it, spent $5,000-$10,000. Now they've split that title into 2, and now you're paying a body corp. So even though it is good because you've got a bit of an uplift when you strata title, you get a bit of an equity uplift. Nevertheless, now you've got a body corp to pay. So even though on the face of it, your cash flow seems really good, actually your net yield is much more depressed. So even on the face of it, you might be making 6-7% yield. Your net yield is actually much more depressed because you're paying an additional cost to the body corporate. Okay, and that's the other thing as well. I think we're up to number 5 or whatever we're up to. That's the other thing. Most people buy for cash flow, which is actually a positive of duplex. But the reality is that instead of spending $700,000 on a duplex and getting, well, let me tell you a real example. I was on the phone the other day with a with a person. He was spending $650,000 on a duplex and he was going to get $700 in rent. On the face of it, he was elated. But why not buy two properties at $350,000 and get, $350 or $400 a week in rent for each of them? When you put those two together, you're spending the same amount of money, or you might be spending a bit less and getting the same amount of rent, if not a little bit more. All right, and I'm just giving you like one or two examples here, but take the principle from this. You can spend $700,000 or $600,000 on a duplex and get $600 or $700 in rent, and on the face of it, the yield seems really good. But you can achieve that same outcome by buying two properties of around $300 or $350. In fact, you can get a better yield on those properties than you would on a duplex. So once again, you're kind of going through all of these downsides of a duplex, and you can achieve that same cash flow outcome through another method. It starts to make you wonder why people jump into the duplexes so readily. Okay, so the next thing is depreciation. Now, many of the reasons why people jump into a duplex is instant equity, the cash flow, which we've both debunked to some extent, but then it's brand new, great depreciation. This thing, even though on a pre-tax perspective, it's giving us $5,000 positive cash flow after tax, great depreciation, my taxable income's gonna come right down. This thing's gonna make me $10,000, $15,000 a year. Now, here's the deal. Just Google Australian tax law, capital gains tax. What actually happens is if and when you sell this property, this duplex, all of that depreciation gets added on to your capital gains tax. So you're actually going to be paying that money back to the ATO if and when you sell. Now, if you never end up selling, then you can ignore this. But if and when you sell, if you have to sell, you're forced to, which we can't predict, or you voluntarily sell 10 years, 15 years down the line, all that depreciation is sucked back out of you again, and it's a big lump sum that you need to pay to the ATO. So, short-term high fives, short-term gains, long-term pain. Don't ever let anyone sell you a property based on depreciation. It takes 2 minutes to Google Australian capital gains tax formula. Okay, now I don't know what we're up to. I think we're up to number 8, no scarcity. So another problem in duplexes is that, let's say you are buying in those Ipswich areas or Moreton Bay Council areas in Brisbane, or Logan areas in South Brisbane, or around the Hunter Valley or in Newcastle. Sure, cash flow is good, instant equity is good, but the thing that you have isn't that scarce. Okay, and once again, this isn't kind of like advanced property investing or anything, but one of the fundamental rules of property investing is that you should buy something that there's not an abundance of. Because if there's an abundance of a thing, that means supply is high. When supply is high, prices don't really rise, right? Supply demand, it's just economics. So many of these areas, there's like 1,000 duplexes going in, like that kind of West Newcastle example around, I think it's Maitland's area, Farley especially. There's just so much developable land supply. There's so many of these duplexes going in. You may think that you've got a good deal, but so do the 1,000 other people that are buying in that area through various property marketing companies. They think the exact same thing. Now, 1,000 people buying 1,000 duplexes, I'm exaggerating a little bit, in the same area can't all have gotten a good deal. Okay, so that's a fact. I know that on your Facebook news feed or on Instagram, you're gonna see those Facebook ads, the sponsored ads. They're gonna have the bold italics writing $100,000 to $200,000 of instant equity. They're gonna have a picture of a mum and dad, in front of their brand new duplex. Guys, I'm trying to explain to you how this stuff actually works. If you're still happy to go ahead, there's plenty of good duplexes you can buy as well. But just be careful. For example, right now in the Airbnb, I'm in an Airbnb right now. This isn't my house. I'm in Bella Vista in Sydney. So just down the road from me, actually, there's a duplex. It's a corner block. It's in an established area. This old part of Bella Vista was established, I think, 20 or 30 years ago. each of the sides, if it was strata titled, would probably sell for $1 million. There's so much scarcity, you can't build around here anymore. It's flanked in either side. In fact, this whole street is worth houses between $2 and $3 million. So this is a duplex worth buying, when it was built back in the day. This isn't in some open space of land with, unlimited hectares to be developed in Newcastle or, Park Ridge or, someplace like that in Queensland. Okay, so there are good duplex, don't get me wrong. Sometimes you can get good ones on the sunny coast as well in Brisbane, but you have to be very selective of the area. And then the final downside, I'm sure there's more, but just to keep to the main ones, the final downside of a duplex is its resale value. They're hard to sell. Now, once again, this is a generic statement, there's always exceptions, but they're pretty hard to sell. Now, just think about this logically, right? You've got a house, whether it's strata titled or not, it may or may not even look like a house. You've got 2 separate entrances, garages, driveways, bedrooms. The type of person who's going to buy this is most likely only going to be an investor, especially if it hasn't been cut up yet, if it hasn't been strata titled. In other words, it's just one big title, one lot, one block of land. And so it's not like an owner-occupier is going to buy a duplex, like have their kids live in one half and the parents live in the other half, right? It's going to be an investor. Now, right now, in 2021, of all the properties sold in Australia, or bought in Australia, I should say, about 15% of them are investors. So if you're trying to sell a duplex right now, it's really hard, right? In the future, that might change. I know back in 2016, about 40% of all purchases were investors. That was in the boom. Right now, it's not like that. So regardless, you're alienating the majority, not the majority, a large minority. No, you are alienating the vast majority of potential buyers, because our investors are only ever going to be a maximum of 50% of the people looking to buy a particular house in general, on aggregate. So why would you think it's easy to sell a duplex when the demand, the pie is cut in half? The number of people interested is half at best, if not down to 10-15%. So it's hard to sell. So if you're buying a duplex, not only for the reasons of depreciation, but for the lack of resale value or ability to sell it in the future, you probably will have the strategy, or should have the strategy, of never selling it, okay? It's kind of like your cash cow, even though you can achieve the same cash outcome through, other types of properties, but it's a cash cow. You probably should buy it with the intention of never selling it, okay? So let's just recap. The main positives are instant equity over 2 or 3 years, which you can achieve through data-driven capital growth, orientated suburb selection anyway, but let's give kudos where it's due. You can achieve instant equity, $100,000, $150,000 up to perhaps in a duplex over 2 or 3 years time of build and development approval, building approval, tendering, by the time you get a tenant, 2 or 3 years perhaps, or sometimes it's less, but let's just go with 2 years, instant equity. But that's not 100% guaranteed. I know everyone promises it, it only happens sometimes. And the second pro is the good cash flow. Now that cash flow can be achieved through other types of properties, but nevertheless, let's give credit where it's due, it's got good cash flow. The downsides are that the capital growth is inferior, because generally speaking, these duplexes, especially the ones that are marketed more to the general public, are in fringe areas. Land to asset ratio is really bad. They're very expensive, which means that most people can't buy them. The bank penalizes you from a borrowing capacity perspective, which in turn limits your total portfolio value, which in turn limits your passive income generation in the long term. If it's strata titled, the net yield is lower than the gross yield and it ends up having no advantage really versus a traditional property. You can achieve the same outcome cash flow wise, yield wise, by 2 smaller properties, provided you know how to look for positive cash flow property. Depreciation, which is a key selling point, is actually completely false. There is no scarcity in duplexes generally, because as you know, if you just walk around, or not walk around, but you ask on a forum, You know, who's buying a duplex? There are so many people buying the exact type of duplex in the exact area that you are, because everyone's seeing the same ads. And then lastly, I think number 9 is that they're really hard to sell, because you're not selling to owner-occupiers, you're predominantly just selling to investors. So I think that's 9 things, if I have my math right. 2 pros, 9 downsides. There's still a good idea if you acknowledge everything that I've said and it still makes sense in terms of your strategy. Now, everyone is different. I don't want to come across as preaching that these are bad in every instance. They're not. But the point of this video is most people think that they're a godsend, and they are really not. They fail to recognize all these downsides. But if any of you who are actually selling duplexes watch this video, I'm not having a go at you. These are just facts, and I encourage people to still look into them, but think twice, think 3 times. Take all these things like depreciation, growth, instant equity, cash flow with a grain of salt. Do your research and you'll get a good outcome. But tell me, have you seen an ad selling duplexes? Have you been enticed to buy a duplex? Have you actually bought a duplex? Let me know in the comments below if in any of these 2 pros, 9 cons, you disagree, you agree, you have a different opinion. Comment below and tell me what you think about duplexes. All right, so my name's PK, and if this video was useful, I know so many of you in my Facebook group, I think there's about 6,000 people almost in that private Facebook group of my clients and investors. I know so many of you have been asking for this video, so I'll try to remember who was asking and tag you below. But if I haven't tagged you, I hope you find this. If you're watching this and got value, just hit the like, love button, comment below, tag someone that you know will get value. If you're watching on YouTube, hit subscribe, and you will get so many more videos like this one. Okay, and I'll leave a link below as well of how you can learn all of this stuff yourself in much more granularity and actually build passive income based on facts, not opinions. My name's PK. Take it easy.